Good morning and welcome to this special edition of OakCrest Insight. During volatile markets, I like to be in front of clients more to review with them what is causing this volatility and our thoughts on the economy. Here in October, we had a very volatile market, both in the US and internationally. Now, this market sell-off occurred over the course of about 3 weeks, compared to February's sell-off, which occurred over the course of only about 10 days. Now, why this sell-off occurred was from a couple factors. The first is the Fed Reserve said it was going to be less accommodating with interest rate volatility. The markets have certain expectations for interest rate raises, and this created uncertainty of just how high they will go and what this will do to the economic expansion which we've been occurring. Our thoughts are that in 2019, they're not going to raise rates as much as anticipated, as inflation is lower than their desired goal, and the markets want them to slow down as well a little. The second factor was the stress on the markets with global tariffs and how this could inhibit GDP growth moving forward. Our thoughts on this as well is they will start to slow down a little bit and hopefully come to a compromise for both sides to stop these additional tariffs. Lastly, corporate earnings came down a little from the all-time highs it had been experiencing. One of the companies that had been helping with this growth over the last couple years was Amazon. And through October 29th, Amazon had lost 23.17% over the trailing month here. Corrections like what occurred in February and here in October, where the S&P 500 is down about 10%, are healthy corrections. We want to continue to prepare clients for events like this, as they are occurrences that traditionally happen a few times a year. I want to show you a chart that goes through the end of September 2018. This chart is a great reference to watch. What it shows is the S&P 500 intra-year declines versus calendar year returns. So the red dots show how much the S&P 500 dropped at some point throughout the year, and the bar shows where the S&P 500 ended up or down at the end of the year. For example, the red dots show an average intra-year drops of 13.8%, but the S&P 500 annual returns were positive 29 of 38 years at the end of the year. As you can see, sometimes the market drops double digits throughout the year, but can end the year on a positive note despite this volatility. This is important to remember as investors, as we don't see this occurrence as widespread and long-lasting during this current market volatility. Now the good news. The fundamentals of the economy have never looked stronger. GDP grew by 4% in the third quarter. Interest rates are low inflation. The labor market is in the best shape in over a generation, and good corporate earnings. The main theme I want to reiterate to clients is to not make any rash changes at this point, as we think the market will find its footing and continue the growth and expansion that has been occurring the last few years. The bottom line is that obviously there are concerns, and the media can always find a wall of worry, but a significant sell-off was inevitable. Now expectations are more realistic, and some air has seeped out of the bubble, which is a good thing. Downturns in the market are fundamentally transitory events. They are hard to predict, but history has shown that staying invested in the stock market over the long term delivers an average annual return of roughly 8%. Now, that's a return worthy of a little patience. I hope this was helpful for you, and we look forward to seeing you next time on OakCrest Insight.